Quote, "Diversification is a protection against ignorance." End quote. Warren Buffett. Have you been investing without seeing any returns, or are you just beginning and looking to get into investing? Do you hope to one day be driving a jaw-dropping supercar, sipping on some champagne like some investment bankers? Well, today I've got a video for you based on the teachings of the great Warren Buffett on how to make millions with little capital and just 3 stocks. Before we get into making millions with just 3 stocks and a little capital, if you like our cutting-edge investment content curated by professionals with decades of entrepreneurial and investing experience, consider subscribing to our channel and join in on our alerts so you never miss our new content. Warren Buffett's investing philosophy can simply be summed up as long-term value investing. It's what has allowed him to invest in so many great companies like Coca-Cola and Wells Fargo. But Warren Buffett himself was, at a time, one of the richest men in the world, so his views on value investing must be legit, right? So what exactly is value investing? Value investing is an investment philosophy that embraces buying stocks that appear underpriced, according to the analysis of its market. To put this in the simplest of terms, it means finding low-priced, high-value stocks and settling for the long haul. Low-priced stocks in this case doesn't simply mean stocks with a low purchase price and growth potential. It means stocks that the market is underpriced due to one reason or another. Warren Buffett advises that, as investors, one should buy these stocks and hold them for long-term investments. This philosophy does not require one to time the rising and falling trends of the market or to take unnecessary risks. It requires persistence in finding them, patience in holding on to them, and the ability to resist the temptation to jump ship. It also requires one to have a good eye for good businesses. The value is in the essence of the business, its growth, the fact that it retains and grows its customer base and its management, not what's popular on the market. From Warren Buffett's experiences over the years, he has learned the wonder of compounding interest. That means if you analyze the customer base, growth history, assets, earning potentials, and financials of a business, and you believe it sparks a worthy interest to invest in, you should go for it and sit back and actively observe the investment over time. It's common among new investors to take risky paths and try to live by buy low, sell high, like stock trading is gambling. This has not worked out for a majority of them. Selling too early ends up losing the gains that they would have gotten from long-term buy and hold investments in good businesses. So how do you invest in good businesses? You collect information and make decisions based on extensive analysis. You should know yourself and be sure of your financial situation before you start following friends and finance gurus online and make risky investments. Let's take a page out of Warren Buffett's life and analyze his investment strategy. In the 1960s, American Express, or Amex, was seeing itself face a crisis due to a particular Saudi oil scandal. Due to the scandal, the entire futures and commodities market was almost wiped out, causing its stock price to plummet. But Warren Buffett saw through the artificiality of this scandal and saw this as an opportunity to invest in a great company at a low price. He determined that Amex had enough solid competitive advantage and a loyal customer base to not be held down by the scandal and decided to buy a total of $1.3 billion worth of Amex stock and continued to invest in it until 1995 and held on to it since. Nowadays, Buffett's Amex investment had grown to over $22 billion, which is approximately a 17 times gain with an estimated dividend rate of 23%. Buffett also invested in Coca-Cola when they were less popular and were going through the after effects of the Black Monday, which was a crash that occurred in 1987 due to a strong bull market that was long overdue for correction. Seeing that the company's stock was undervalued, Buffett bought approximately $1 billion worth of their stock and began to own a huge percentage of the most successful soft drink franchise. Today, compound interest has played a significant role in the value of this Coca-Cola investment, which is now worth over $20 billion. And he received $704 million in dividends in just 2022 from this original investment. Buffett has kept the stock for more than 30 years while reinvesting the income. Warren, through the years and to this day, has a small number of investments and most of them have experienced great returns. He doesn't want or need a highly diversified portfolio because it stretches him too much attention-wise. That's why he advises that a good investor only needs 3 good stocks to start realizing significant capital growth. But this depends on the kind of person you are. If you know you're not the kind to analyze and understand the company's earning potential, you can just put your money in index funds or ETFs, also known as exchange-traded funds, and follow the S&P 500 companies. The steps you need to take to start making millions with just 3 stocks are: Number 1. Make long-term investments. Number 2. Look for high-quality companies. Number 3. Buy undervalued stocks. Number 4. Have a concentrated portfolio. Thank you for watching. Tell us what you think the best 3 stocks are by leaving a comment in the comment section below. If you like our cutting-edge investment content curated by professionals with decades of investing experience, remember to like this video, subscribe to our channel, and join in on our alerts so you never miss our new content. Oh, and check out our other popular video on the screen.